Hi there, welcome to Neppy Invest. Breaking out is there two more horrifying words for teenagers. Thankfully, I don't think there's many teenagers who are watching my videos, so for those one or two teenagers, a bit of a shudder's probably gone through your body because nothing worse than breaking out. But when you compare that to, say, a company on the ASX or any company within the world, when their share price is breaking out, that's actually really good news. So I'm always on the lookout for companies' share price that are showing signs of breaking out or have broken out of any sort of being in the doldrums, or being sort of forming a base or anything like that. So always look out for companies who are breaking out. So in this video, I'll be giving you some ideas of companies that are breaking out. So the whole point of this video is sort of give ideas to you. And if I give one idea to someone out there and it's a positive idea, then this video is a success. So if you do develop some ideas about the companies I show you, and you like it and you decide to buy, and then a few years later the share price has gone up substantially because you bought, because I've given you an idea. And of course, make sure you do your own research. Don't just buy because I've given you an idea. But if that happens, I think this has been a success. So let's get stuck into it. Going through the companies that are breaking out. This is not be or end all of all the companies breaking out. There's a plethora of companies breaking out at the time, just because the stock market is going up and very positive at the moment. So the first company is Australis Oil and Gas. As you probably can tell by the name of the company, the sector they're in is quite obvious. So they're in the oil and gas. I believe they have operations in Louisiana and Mississippi, maybe a little bit more. So they are operational. They do produce money in cash. You can see a market cap of only 51 million, but they still produce 55 million in revenue and operating cash flow positive. So fairly positive, just like that. So of course, because they are in the oil and gas industry, that sector has gone through a horror period the last few months, and we've seen the share price really base in the last 5 or 6 months between about 2.5 cents and 3 cents. Now, I don't really buy a company that's just basing out like this. I always wait for a bit of a breakout, and we've definitely seen that breakout happen in the last 2 weeks. So share price has gone from 2.5 cents to 5.2 cents as a close on Friday, the 19th of November. The market's got really excited with this company. You can see the breaking out in the share price has corresponded to a breakout in volume. So when you see a really substantial increase in volume corresponding to the increase in share price, that's really bullish. Someone's getting excited. It could be maybe some fund managers getting excited because this is a cash flow positive company. And you can just see on the right, or the middle bit section there on the right, is I've just put the last 9 trading days there. And you can see the last 2 numbers are the most important, which is the percentage change and the volume traded. So you can see on the 18th of November, share price went up 40% on 76 million shares traded. So this is a company that I'm very excited about the potential moving forward, because especially if the oil prices go for a long-term uptick in share price, this company might see a substantial increase in their share price moving forward, simply because they are a small cap, and sometimes the small caps run the hardest in these sort of circumstances. So this is definitely on my watch list. I'm only paying very close attention over the next few days to see how the share price reacts, and potentially even a buy in the next week. The next company is Syrah Resources. Their code is SYR. Market cap 280 million. This is not a company that is in production. They're into graphite. They have a project, I think it's something like Tanzania, somewhere in that part of Africa, I think. And they're still going throes of getting into production. I forget what they have to do. But anyway, this was a darling of the stock market about 3 or 4 years ago. We saw the share price get upwards of $5 or so, and then we saw a very long-term downtrend develop from start of 2018, which lasted all the way to June this year. And then in the last 5 months or so, we've seen the development of an uptrend, and this is a very distinct uptrend developing in that time frame. This is a classic uptrend. You won't see a better uptrend than this, or maybe you will. But anyway, I'm not as interested in Syrah Resources, so this is one of the companies I just want to give an idea to those people who might be liking this sort of company. The main reason I'm not a big fan of this company just because they're not in production yet, and I don't really have the financials. I prefer a company that's in production, has some financials backing it. But anyway, for the whole purpose of this video is just to give you, the viewer, some ideas. And during the last few weeks, we've seen the share price go from 45 cents to 68 cents. If I'm right, that's a 50% increase in share price. So it wouldn't surprise me to see the share price pull back towards 50, 55 cents just because of this, pretty good run over the last few weeks. I've mentioned before that this had a high of about $5 start of 2018. So this was a classic downtrend. So we had a classic downtrend developing into a base, and now we've seen development of a classic, potentially a classic uptrend. So there was no point buying Syrah Resources from about, say, February 2018 to about now. It was in a downtrend. What's the point of buying in a company that's in a downtrend? Some value investors might disagree with me there, but you could have thought this was good value, say, around here or so, June 2018, because the share price was only $3 when it was $5 a few months ago, and then you would have just lost value over time. So I'm a really big fan of only buying companies who are in developing uptrends or who are in uptrends, and then selling out if we see a long-term downtrend develop. And we've definitely seen that with Syrah Resources. So if you're a fan of this company, I'd say it's a good time to buy. Maybe not tomorrow or the next day. Maybe if the share price pulls back a little bit. So the next group of companies all fall in the same spectrum, sort of that finance spectrum. That's probably the best way to put it. So if you want to finance a car through work, this is who you go to. So SG Fleet, McMilland, Shakespeare, and Smart Group. They've all been in the doldrums the last 1 or 2 years, and we've seen the share price base. But definitely SG Fleet and McMilland, which is the top two charts there. And we've seen the share price starting to break out, a really good uptrend possibly developing over that time period. So these are real companies, market caps between $500 million and $1 billion, good revenue and good operating cash flow for all three of these companies. Smart Group's the only one that really hasn't broken out. We did see the share price go back a bit in late October, going from about $6 to $5.20. And even though share price has increased from there, we're still seeing a bit of a downtrend playing out there. So we haven't seen a reversal in the share price, unlike SG Fleet and McMillan. So if you like these sort of companies, if you've been thinking of buying them, maybe around now is a good time to buy. Just wait to maybe see if these uptrends remain. So I'm actually a fan of maybe buying one of these companies just for a play, and just riding the company's uptrend as long as possible. Next company is Air New Zealand. Okay, first of all, I'm not a big fan of capital-intensive businesses, and airlines definitely fall into that category. So, although it's just like Syrah Resources, this is probably a company I probably won't buy, but just again to give people some ideas of companies that are starting to break out and developing into uptrends. So this is Air New Zealand. That's pretty obvious what they do. So market cap 1.8 billion, revenue 4.6, the trailing 12 months, operating cash flow 228. So a lot of their revenue goes into capital, capex, that sort of thing. But definitely seeing uptrend develop, you can't argue that. And I could have included Qantas, but a company like Qantas, the time to buy Qantas would have been 6 or 7 years ago when the share price got to $1. And that's when I would like to buy this sort of companies, when their share price is at the extreme low, when sentiment's shot, which Qantas was back then. People were thinking it was going to go bankrupt. And Air New Zealand, of course, because of COVID-19 vaccine, the market's thinking people are going to travel more in the next year or two, and that's definitely a possibility. Myer. And so hands up who loves this company. Hands up who thinks this company is going to last the next 10 years. And so my hand's not definitely up here. Now, even though I might not like a company, so there's a lot of companies I don't like, but that does not preclude me from buying those companies for the short term, medium term, if they develop into a bit of an uptrend. So I've held Myer in the past, and I'll get into that into a second. But we're showing the market getting very positive about the Myer. Definitely the last 2 days, we've seen a share price go from about 28 cents to 34 cents on really good volume. So the market's really liking what's happening with Myer. And you can see the market, 275 million, revenue 2.1, operating cash flow 192 million. I'm going to have to look at that to make sure that's real. So I just threw these numbers in there, really didn't look at it. Because if the operating cash flow is 192 million, with the market have 275, that would say Myer is quite cheap. But more than likely, we'll see revenue and operating cash flow go down over the next few years. But the market's thinking with COVID-19 vaccine kind of becoming soon, lockdowns becoming less likely moving forward unless we get more outbreaks. The market's thinking people are going to go shopping out more, which is probably true. But Myer's always had a bit of a problem because it's not sort of the sector that's a growth sector. In fact, online shopping is going to increase and continue to increase moving forward. And the brick and mortar sort of retail story is, I won't say at an end, but it's a diminishing growth story. But anyway, it's looking like it's breaking out, and I'll never discount a company's or buying into a company if they're showing signs of breaking out. And it's what happened in 2019, around March. I actually did take a bit of I did buy into Myer for a 2-month period. So I bought around 47 cents on a bit of a breakout. That was a definite breakout. Saw a share price increase on high volume. I think it was something to do with good results. And I just went, the market's going to like this for a few months at least. And we saw share price go from 47 cents to above 70 cents. And then it started to drift backwards. We saw a potential head and shoulders just before I sold out. And when that share price fell by a fair bit on one day, that's when I decided to sell at 65.5 cents, and the share price was retreated since then. So again, even though I don't like Myer, the company, I don't think it's got long-term viability. You should not discount buying into the company short-term because you can make a fair bit of money holding for a short-term period because short-term uptrends definitely do happen even in companies like Myer. And in this circumstances, I made a profit of 40% in, was it 2 months? Yeah, 40% in 2 months. Next company is ServiceStream. Now, this is a company I've followed for the longest period. I've never bought into this company, even though I've liked it. Something's just held me back. And one of the reasons it's held me back is the operating cash flow. So market cap of 940 million, lots of revenue, margins fairly low when you consider the operating cash flow is only 58 million. But this is another classic uptrend or developing uptrend in the past few months. In fact, the breakout was late September. If you can just see my my mouse here, right, this is when the breakout happened. There would have been some good news on that day. We saw the share price zoom up, and then we saw the share price over the next 5 or 6 trading days go sideways, which is very bullish, in fact. Then we saw an uptrend in share price. Share price went and tested this point, this $2 point. So $2 in itself is a support line. So whole dollars tend to be supports. And then it bounced off that support line and started going higher again. So classic uptrend where we saw support being tested and this up day here, a very bullish up day. So if I was thinking of buying this company, this was when I would have bought it. But again, because of the operating cash flow, 58 million, I decided just to hold back. But if you are interested in this company, could be a good time to buy. So Eclipx Group, very similar company to McMilland, Shakespeare, SG Fleet, and Smart Group. This is not a company I've held in the past, and when I bought this company, it's sort of a buy strategy that I don't recommend really anyone to. They had a really bad announcement. I think the share price went down something like 40%, and I bought in for a very short-term trade. And I wouldn't recommend that. You need some, you have to keep your emotions in check. But this is a developing uptrend that's been happening for about 5 or 6 months. A very nicely, slowly developing uptrend. I love these sort of uptrends the most. Not a lot of volatility in the share price, not a lot of big swings. And we've definitely, over the past few days, we've seen the share price go above $1.80, and that $1.80 or $1.80, I think it's $1.80, is a price of resistance, and now it's pulling through that, so that might become price of support. So you can't complain about this company. I know there are a lot of fans of Eclipx Group. And you can just see there the market cap 580, an operating cash flow 417. I'm going to have to look at that too, because if the operating cash flow is 417 on a market cap of 580, this is a fairly cheap company even at these prices. So I'm going to have a look at this company a little bit more and potential buy if that operating cash flow is real. Next company is a very small company, Veris. Market cap of 32. They do have a fair bit of revenue and they are operating cash flow positive. They've gone through the wars, not literally, over the last 3 or 4 years. Share price has fallen from something like 35 cents to 3 cents. I think they do surveying, they're in services, surveying services, infrastructure services maybe. But yeah, the market hated this company for the longest time, but it looks like that market sentiment has turned around in the last 2 months or month and a bit. The only thing holding me back against Veris is the lack of volume in the past month. We did see volume increase on the breakout, which happened early October. Around this point was where the breakout happened, these 2 big up days. And the next few days would have been a good time to buy because the share price went sideways, not down. But the increase in share price has not corresponded to an increase in volume, and I don't like to see that. So it wouldn't surprise for me to see the share price pull back on low volume over the next month or so. So just putting this into my watch list just to see how it goes. And if there's any really good financial news moving forward with this company, that could be a good time to buy, because I think there could have been some contract wins they had, which could have been the impetus for the increase in share price. I'm not sure, but I prefer, instead of contract wins, I prefer to see increasing financials corresponding to an increase in share price. Some of you might be surprised that I got this on this list, this company. So I'm a very big fan of EOS. You probably shouldn't be fans of companies, or don't fall in love with companies anyway, but this is showing signs of developing uptrend in the last 2 weeks. And this is always something I look for. This is without doubt. So we're starting to see share price around now. So share price is right at a zone of resistance. And if it pulls through this zone of resistance, we will see this potential uptrend develop more, I think. And the main thing I look for is, you can just see the 3 moving averages I use are starting to move upwards, with the black line, which is the 20-day moving average, greater than the red line, which is the 50-day moving average, which is more than the blue line, which is 100. So you can just see a few weeks ago, they were all closely bundled together, and then we started to see them spread apart. And that's when you start to see a developing uptrend first form. So this could be the start of a new uptrend for EOS, Electro Optical. I do believe that there is potential for this company to be significantly higher valued in the next 5-10 years. So this is a long-term hold for me. So it is within my long-term portfolio. But in saying that, that won't preclude me from buying a trading parcel. So even though I have it in one portfolio, I might actually buy into EOS into my momentum sentiment portfolio and just ride this uptrend as long as possible. And maybe any profits I can transfer to my long-term portfolio. So the last company, actually, it's not really the last company because I'm going to have a look at a group of companies after this, but the last solo company is Flexigroup. So this is a buy now, pay later group. It's probably doing worse than all the other buy now, pay later because it's called Flexigroup when their buy now, pay later options are called Hum and Bundle, and they will be changing the name to Hum. So it'll be interesting to see what the market, or how the market reacts when they officially change the name, when some of those amateur investors who are really into buy now, pay later see, oh my God, you can buy now Hum now. Wow, you can buy Hum. I didn't realize you could buy Hum, even though they were called Flexigroup. But anyway, we are showing the potential signs. So EOS is showing good signs of a breakout. Flexigroup is showing it's not breaking. I wouldn't call this a breakout just yet, but it is showing signs of potential breakout in the next few weeks or next few months, because the share price in the last 2 days has really taken off, and it's corresponded to really good increases in volume. So I believe the reason why the share price has taken off was some good news about collaboration or an agreement with MasterCard. So those sort of announcements I don't like to buy off, because it can be a lot of fluff, especially if there's no financial data within those announcements. But I've put this onto my watch list just to see how the share price reacts over the next 2 weeks to see whether the share price can sort of go sideways from here instead of coming down again. If it comes down a fair bit, we still might see an uptrend develop, but it'll be less bullish. So I'd like to see the share price move sideways over the next week, not really developing into any sort of, if I say share price go below $1.10 again, that would be fairly bullish. Share price stays above $1.20, that'll be bearish in my mind. So again, this is a real company. It's probably the most real buy now, pay later because they are profitable, do have operating cash flow, but because they're not the in thing, they do have lower growth too, but they're not the in thing, so they're not as popular as the other buy now, pay later. In fact, I'm using Flexigroup as sort of a barometer to see how real the buy now, pay later sector is. If it's real, Flexigroup share price should take off because they have a really big, their hum and bundle is a really big market player within the group. So the share price of Flexigroup should be quite high based off what the other buy now, pay later companies are doing. But always in the back of my mind, I think, I go back to airlines. So if you go, say, a couple of decades ago, 3 or 4 decades ago, airline industry or airlines would have been a good place to buy because the airlines or the airline industry, flying through the air would have been sort of an industry that's going to take off in the next few decades. That's the thinking was. But because the airline industry or the airline itself was hyper competitive, we didn't see any companies really take advantage of that, and we didn't see any airlines you would want to buy in for the long term. In fact, we saw a lot of bankruptcies in airlines, and we continue to see that to this day. And to my mind, buy now, pay later could be in a very similar place than airlines because it's highly competitive. We're seeing a lot of competitors come into the buy now, pay later. There's not a lot of barriers to entry, and that's my one little concern about buy now, pay later is there's going to be a lot of action. It's going to be a growth area, but there's not going to be any winners just because of the competitive nature of the sector. So that's my one little takeaway from the sector. So I wouldn't be surprised to see in 10 years that all these buy now, pay laters not fail, but they're not really good companies to buy in. If you disagree with me, leave a comment. I'm always up to some people challenging what I think. So the last group of companies are the banks. So I'm not a massive fan of banks, but they always have their place within a portfolio, in my opinion. And right now, they're all showing signs of developing into an uptrend. Now, they still have lots of headwinds moving forward, simply because of interest rates being so low. I'd prefer interest rates to be quite high. So if I had a choice of the banks, I'd probably maybe lean towards the smaller banks like Bank of Queensland, Bendigo Bank. Commonwealth Bank always has a premium because it is the higher quality bank. So I might maybe trend towards Westpac, NAB, or ANZ. So I'm going to look at more closely these companies, these banks. Hope to see a bit of a decrease in share price over the next week or so because it's run really hard in the last 9 or 10 trading days. So I'd just like to see a bit of a retracement in share price before I buy. So the banks are on my watch list over the next few weeks, and there is potential I might buy into 1 or 2 banks moving forward, even though they're not my favourite, but I just want to see if I can just ride the uptrend moving forward, because who knows what's going to happen with interest rates. The RBA says the interest rates won't rise for the next 3 years, but that's hocus pocus. It could rise if it's if we start to see inflation take off. Who knows? So you should never say never when it comes to anything to do with the world. So that's all I've got on these ASX stocks that are breaking out. Hope you've enjoyed this video. Hope you've taken something away from it, maybe taken some ideas. So I do these videos for educational, entertainment, and research purposes, even research for my own end. Again, I'm not a professional advisor, so if you do need some advice for your own financial circumstances, make sure you seek out someone who is qualified. Other than that, make sure you leave any comments if you disagree with me or whatnot. And that's all for today's video. Have a good day. I'll talk to you later. Bye.